Imagine waking up one morning to check your investment account, only to find it's lost 30%, 50%, or even 70% of its value overnight. Your dreams of financial freedom, early retirement, or securing your family's future suddenly hang by a thread. You're not alone. Millions of people around the world have faced this reality when a stock market bubble bursts. And right now, experts are warning that we could be on the brink of one of the largest market bubbles in history. Bubbles are not new. They're part of financial history. Investment, from the Dutch tulip mania in the 1600s to the 2008 housing crisis, human behavior repeatedly fuels extreme highs, only to be followed by devastating collapses. The psychology behind it is always the same. Investment. Fear of missing out drives people to invest recklessly, while euphoria blinds them to risk. The problem is bubbles often start quietly. Stocks go up steadily, returns look easy. Investment, and everyone starts believing the market will continue to grow forever. But history shows us that bubbles aren't just numbers, they're warnings. They destroy savings, wipe out retirement plans, everything made financial panic that spreads through entire economies. And right now, several indicators are flashing red. Asset prices are inflated far beyond historical norms. Nothing memes stocks are skyrocketing without sustainable business models, and debt levels are at record highs. You might be thinking, this won't happen to me. I'm careful. I diversify. But even the savviest investors can get caught off guard. The truth is, most people underestimate the risk of a bubble because it's happening slowly, and they assume it can't affect their carefully chosen stocks. That's why it's critical to understand the warning signs, recognize risky patterns, and learn strategies to protect yourself before it's too late. Makes a good investment. By the end of this speech, you're going to know exactly what to watch for, how to prepare, and how to make decisions that could save your life savings. This isn't fear-mongering, it's reality. And if you act now, you don't just protect your wealth, you position yourself to profit when others panic. So buckle up. We're about to dive into the world of stock market bubbles, why they happen, and what you absolutely need to know to survive and even thrive when the next crash hits. Stock market bubbles are a phenomenon that many people hear about, but few truly understand until it's too late. At its core, a bubble occurs when asset prices rise far beyond their intrinsic value. Imagine a balloon being inflated. You keep pumping air into it, thinking it can stretch forever until finally it bursts. In financial terms, this bursting translates to a rapid, often catastrophic decline in the market, wiping out wealth that took years to build. What makes bubbles particularly dangerous is that they are rarely obvious while they are forming. They usually start quietly, with certain sectors or stocks performing slightly better than expected and drawing more investors in. As confidence grows, more people jump on the trend, not wanting to miss out on easy gains. This is where the psychology of investing plays a critical role, because human behavior often drives markets more than actual economic fundamentals. There are several factors that contribute to the formation of a bubble. One of the biggest drivers is the fear of missing out, or FOMO. When people see others making huge profits in a particular stock or sector, they feel pressured to invest, even if they don't fully understand the underlying business. This behavior creates a feedback loop. Investment. More demand drives prices higher, which attracts even more investors, pushing prices further from reality. Another factor is herd mentality. Individuals tend to follow what the majority is doing rather than making independent, rational decisions. The result is that investments are made not because of their inherent value, but because everyone else is buying. Easy access to credit and leverage also plays a huge role. When investors can borrow money cheaply to invest, it amplifies both the rise in prices and the potential losses when the bubble bursts. Essentially, leverage allows people to bet bigger than they could with their own money, which inflates the market even faster. History provides us with clear examples of how destructive bubbles can be. Take the dot-com bubble of the late 1990s and early 2000s. Technology stocks, particularly internet-based companies, skyrocketed as investors poured money into any startup with a "come" at the end of its name. Investment. Valuations were often completely disconnected from actual earnings or business models. When reality caught up, the bubble burst. Investment, wiping out trillions of dollars in market value and destroying the retirement savings of countless investors. Similarly, the housing bubble leading up to the 2008 financial crisis saw real estate prices climb to unsustainable levels, fueled by subprime mortgages and speculative investment. When the bubble popped, banks failed, millions of people lost their homes, and the global economy entered a severe recession. These examples demonstrate that while bubbles may create the illusion of easy wealth, investment, they also harbor the potential for devastating losses. Recognizing a bubble early is both an art and a science. There are several warning signs that investors can look for. Rapid price increases that are not supported by earnings or economic growth are a major red flag. If a stock or sector doubles in value in a matter of months without clear justification, it may be a sign that the market is overheating. Unusual investor behavior, such as buying purely based on hype, news, or social media trends rather than fundamental analysis, is another indicator. Additionally, investment when leverage is widespread and investors are taking on high levels of debt to fund their positions, the system becomes extremely vulnerable. These warning signs are often subtle at first, which is why education and awareness are critical. Understanding what constitutes fair valuation, how to analyze a company's financial health, and how to interpret market signals can mean the difference between surviving a bubble and being caught in its collapse. Finally, investment. It's important to remember that bubbles are not inherently malicious. They are a natural outcome of market dynamics and human psychology. The market rewards innovation, optimism, and risk-taking, but it also punishes irrational exuberance. The key is preparation. Investors who understand how bubbles form, recognize the warning signs, investment, and maintain disciplined strategies are in a much better position to protect their wealth. Awareness alone doesn't prevent a bubble from occurring, but it equips individuals with the knowledge to act wisely when markets become overheated. By acknowledging the patterns, understanding the psychology, and remaining vigilant, investors can navigate the complexities of the market and avoid the devastating consequences that have affected millions throughout history. Right now, investment. There are several signs in the market that strongly suggest we could be on the brink of a bubble, and recognizing them early is critical for anyone serious about protecting their wealth. One of the most obvious indicators is the skyrocketing valuations of certain sectors, particularly technology and speculative assets. For instance, we've seen companies with minimal revenue and uncertain business models reach market capitalizations in the tens of billions of dollars. This kind of growth is not supported by fundamentals. It's driven almost entirely by investor enthusiasm and the fear of missing out. When prices climb far faster than earnings or realistic projections, investment, it's a classic hallmark of a bubble. Investors tend to rationalize these valuations by saying, investment, this company will grow into its price. But history has shown that such optimism often collapses under the weight of reality. Another sign is the prevalence of speculative behavior among everyday investors. Social media and trading platforms have made investing more accessible than ever, but they've also amplified hype-driven decision-making. People are buying stocks not because they understand the company or its potential, but because they saw someone else make money online or because a stock has suddenly gone viral. While this creates excitement, it also inflates prices artificially. When large numbers of investors base decisions on hype rather than fundamentals, it signals a market that is increasingly detached from reality. This is particularly dangerous because once sentiment shifts, the selling can be swift and severe, leading to rapid losses. Leverage is another critical factor to watch. Easy access to borrowed money allows investors to amplify their bets, which can significantly accelerate both gains and losses. Today, margin debt levels and leveraged ETFs are at historic highs, indicating that many participants are investing with borrowed money. While leverage can multiply profits during a rally, it also creates systemic risk if the market turns downward. Forced liquidations can exacerbate the decline, making the crash even more severe. The more debt that is tied to speculative investments, the more fragile the market becomes, and this fragility often goes unnoticed until the correction hits. The behavior of institutional investors also provides clues. In previous bubbles, professionals sometimes ignored warning signs in favor of chasing short-term profits. Today, we see large investment funds pouring money into high-risk areas, adding fuel to the fire. When institutions, who usually perform rigorous analysis, start chasing trends instead of value, it indicates that market psychology has shifted toward euphoria. Historically, bubbles are often confirmed when smart money begins to act irrationally. It's a dangerous signal that the market is moving away from fundamentals and toward collective greed. Comparing current market trends with past bubbles also offers perspective. During the dot-com bubble, many companies had sky-high valuations despite minimal revenue. Investors believed technology would transform the world overnight, and they ignored traditional metrics like earnings or cash flow. Similarly, today we see sectors like cryptocurrencies, meme stocks, investment, and even certain tech startups experiencing exponential growth with questionable long-term viability. Patterns repeat because human behavior is predictable. Fear and greed continue to drive markets, investment, often more than logic or analysis. Recognizing these patterns allows investors to step back and evaluate whether prices make sense relative to reality. Finally, investment. It's essential to pay attention to macroeconomic indicators. Excessive money supply, record low interest rates, and high levels of consumer and corporate debt all contribute to bubble formation. When cheap money fuels speculation, it encourages overvaluation in multiple asset classes. Investors need to be aware of how monetary policy, inflation, and interest rates can inflate prices beyond sustainable levels. Ignoring these broader economic signals can leave even experienced investors vulnerable when the market adjusts. Good investment. Understanding these warning signs doesn't mean predicting exactly when a bubble will burst. It's nearly impossible to time the market perfectly. What it does mean is that investors can make informed decisions to protect themselves, reduce risk, and even identify opportunities. By recognizing overvaluation, speculative behavior, excessive leverage, institutional irrationality, repeated historical patterns, and macroeconomic red flags, individuals can avoid getting trapped in a bubble that could destroy millions. Awareness and preparation are the best defenses. Invest, and acting before the panic sets in can make all the difference between losing everything and navigating the market safely. Being caught in a stock market bubble can be a devastating experience, and one that impacts not just your finances, but your peace of mind and future plans. Imagine watching your carefully built portfolio lose 40%, 50%, or even more of its value in a matter of weeks. Investment. It's not just numbers on a screen. It's the retirement you've been planning for, the college fund for your children, the dream home you've been saving for, all suddenly at risk. This is exactly what happened during the 2008 financial crisis. People who had invested heavily in real estate and mortgage-backed securities believed the market was stable, only to see their life savings evaporate almost overnight. The emotional toll of such a loss is immense. Panic, regret, and a sense of helplessness take over, making it even harder to make rational decisions. Investment. The consequences of being trapped in a bubble extend far beyond personal finances. On a broader scale, market collapses can trigger economic recessions, layoffs, and business failures. When asset prices collapse, consumer confidence drops, spending decreases, and companies struggle to maintain operations. In turn, employees lose jobs, and small businesses dependent on consumer demand may close permanently. For individual investors, this creates a ripple effect.
Yes.
Your investments not only lose value, but the world around you suffers too, making it harder to recover financially. The impact is systemic, showing that bubbles are not just isolated market events. They affect the entire economy. Even experienced investors are not immune. Many seasoned professionals fell victim to the dot-com bubble in the early 2000s. They invested in high-flying tech companies that promised revolutionary products, only to see valuations crash when profits failed to materialize. The lesson here is that knowledge alone does not protect you if psychology and market sentiment are driving prices. During bubbles, irrational optimism becomes the norm, and logic often takes a back seat. People convince themselves that this time is different, ignoring history, warning signs, and financial fundamentals. That mindset is what transforms a temporary overvaluation into a full-blown crisis. One of the most painful aspects of bubbles is how quickly they can destroy wealth. Markets can climb gradually for years, lulling investors into a false sense of security, and then collapse suddenly. For example, investment. During the 2008 housing crisis, home prices had been rising steadily for years, leading many to believe real estate was a guaranteed path to wealth. When the bubble burst, investment millions found themselves with mortgages far exceeding the value of their homes. Many faced foreclosure, ruined credit, and financial insecurity that lasted for a decade. The lesson is clear: even long-term investors, investment, if unprepared, can suffer catastrophic losses. Being trapped in a bubble also has emotional consequences. Fear and regret cloud judgment, often causing people to sell at the worst possible time or make impulsive decisions. Anxiety about money seeps into daily life, affecting relationships, mental health, and overall quality of life. Investment, emotional decision-making can compound financial losses, creating a vicious cycle that is difficult to break. For example, during sudden market downturns, inexperienced investors often panic, sell their positions, realizing a fraction of what they initially invested, and then struggle to re-enter the market when prices stabilize. This illustrates how bubbles don't just destroy a wealth, they also erode confidence and rational decision-making. However, there is a silver lining: investment. Understanding the risks and consequences equips you to respond proactively. Recognizing that losses can happen, even to experienced investors, allows you to develop strategies to mitigate risk. Diversification, maintaining liquidity, and avoiding excessive leverage are key safeguards. Preparing for a potential market downturn doesn't mean missing out on gains. It means protecting yourself from ruin. In fact, investment, those who anticipate the crash often have opportunities to profit while others are panicking. Selling overvalued assets or reallocating to safer investments can preserve capital and even create new avenues for growth. In summary, being caught in a stock market bubble is not just about losing money, it's about losing peace of mind, security, and opportunities for the future. It affects individuals, families, and even the broader economy. The combination of rapid market growth, irrational behavior, and excessive leverage creates a perfect storm that can devastate millions. By understanding the consequences, staying vigilant, and preparing in advance, investors can navigate the dangers of bubbles with confidence, minimizing losses and positioning themselves for long-term success. The key is awareness, discipline, investment, and a proactive approach that balances caution with opportunity. Protecting yourself during a stock market bubble requires a combination of strategy, discipline, and awareness. The first step is diversification. Many investors make the mistake of putting all their money into a single sector or a handful of high-performing stocks, thinking that past performance guarantees future returns. During a bubble, this approach can be disastrous. By spreading your investments across multiple asset classes, stocks, bonds, real estate, and even commodities, you reduce the risk of being wiped out if one market segment crashes. But diversification doesn't eliminate risk entirely, but it acts as a buffer, absorbing shocks and providing stability when speculative markets collapse. Maintaining liquidity is equally important. Investment cash or cash equivalent investments allow you to weather volatility without being forced to sell assets at a loss. When a bubble bursts, prices can drop dramatically in a short period. Investment and having readily available funds gives you flexibility. You can cover expenses, wait for market stabilization, or even seize opportunities to buy undervalued assets at a discount. Investors often underestimate the psychological benefit of liquidity. It reduces panic-driven decisions because you know you have a safety net. Investment. This financial breathing room is crucial in preventing emotional decision-making, which is one of the biggest causes of losses during market corrections. Another critical strategy is managing leverage and avoiding excessive debt. While borrowing can amplify gains in a rising market, it magnifies losses when the market turns. High levels of margin debt or loans for speculative investments create vulnerability. If prices drop suddenly, investors may be forced to liquidate positions at a loss to cover obligations. Investment. Retaining a conservative approach to leverage allows you to stay in control, even when volatility spikes. It's better to grow steadily and preserve capital than to chase short-term profits that could vanish overnight. Responsible use of leverage ensures that your financial plan remains resilient under stress. Monitoring valuation metrics and fundamentals is also essential. Look beyond price trends and hype. Evaluate earnings, cash flow, and growth potential. Avoid investing based solely on momentum or social media influence. For example, a company may be in the spotlight with skyrocketing stock prices, but if it lacks sustainable revenue and profit, the risk is extremely high. Conducting careful analysis helps separate speculative fads from real opportunities. Historical patterns can also provide guidance. When asset prices move far beyond long-term averages without justification, it often signals overvaluation. Investors who focus on fundamentals are more likely to survive a bubble because their decisions are grounded in reality rather than emotion. Timing is another critical factor. While predicting the exact moment a bubble will burst is impossible, being alert to market signals allows you to act strategically. Selling or reducing exposure in overvalued sectors can lock in gains before a sharp decline. Conversely, keeping some cash on the sidelines prepares you to invest when prices become attractive after a correction. This contrarian approach requires patience and discipline. Man, it's one of the most effective ways to protect wealth and even profit from market turmoil. Investors who panic during a crash often lose the most, while those who plan and act rationally can capitalize on opportunities that others miss. Finally, adopting the right mindset is just as important as any technical strategy. Emotional discipline, patience, and long-term thinking are essential for navigating bubbles. Recognize that volatility is part of investing and that short-term losses don't define long-term success. Focus on preserving capital, maintaining flexibility, and making rational decisions based on data and analysis rather than fear or hype. Investors who stay calm and disciplined often find themselves in a position to grow their wealth while others are recovering from panic-induced mistakes. Investment. Developing this mindset requires self-awareness and the ability to detach from market noise, but it is the key to thriving during periods of extreme speculation. By combining diversification, liquidity management, investment, careful leverage use, fundamental analysis, strategic timing, and disciplined mindset, investors can protect themselves during a stock market bubble. These strategies not only reduce risk, but also create opportunities to profit when others panic. The goal is not just to survive a bubble, it's to navigate it intelligently, preserve wealth, and emerge stronger on the other side. While no one can predict exactly when a bubble will burst, preparation, awareness, and rational decision-making provide a significant advantage. In the end, those who act wisely in the face of speculation are not just avoiding losses, they are positioning themselves for long-term financial success.